POR 161 changed everything. If you remitted money into Thailand in 2024 or 2025, salary, pension, savings, it does not matter. The Thai Revenue Department may now consider that assessable income, which means a tax bill you were not expecting. But here is what almost nobody tells you. There is a completely legal way to claw a significant chunk of that back, run by the Thai SEC, available to expats right now, and most people miss the deadline without even knowing it exists. That legal mechanism is called RMF, Retirement Mutual Fund, and its close cousin, SSF, the Super Savings Fund. Together, they share a combined deduction ceiling of 500,000 baht per tax year. That is the maximum amount of assessable income a Thai tax resident can legally remove from their taxable income in a single year. Legally remove. Not defer, not shift offshore, not structure around. Remove. At Thailand's top marginal rate of 35%, that translates to a maximum tax saving of 175,000 baht in a single year, from one mechanism that is sitting there, on the table, offered by the Thai government, and most Western expats have never heard of it. Let me put that in concrete terms. A British consultant living in Bangkok remitting the equivalent of 2 million baht a year from UK earnings. Post POR 161, that remittance is assessable income. Their Thai personal income tax bill, before any deductions, sits somewhere around 250,000 baht. Now they contribute 500,000 baht into a qualifying RMF before December 31st. That deduction knocks their assessable income down hard. Their actual tax liability drops to roughly 80,000 baht. That is a saving of 170,000 baht from a single decision made before New Year's Eve. That is not a tax scheme. That is the Thai government literally writing this into law and telling you to use it. Before we go further, let's clear up the three-fund confusion that trips up almost every expat who looks into this for the first time. There is RMF, there is SSF, and there is LTF, the Long-Term Equity Fund, which a surprising number of expats still ask about. Here is the answer on LTF. It is dead. Permanently discontinued as a deduction vehicle after December 31st, 2019. If your colleague mentioned LTF over lunch, they are 6 years out of date. Do not put it on your 2025 tax return. Do not expect a deduction. It generates nothing. RMF and SSF are the live vehicles. RMF contributions are deductible up to 30% of your assessable income, capped at 500,000 baht per year. SSF contributions are deductible up to 30% of assessable income, capped at 200,000 baht per year. But here is the critical detail that most explainers get wrong. That 500,000 baht is not two separate allowances sitting on top of each other. RMF, SSF, Provident Fund contributions, Government Pension Fund, National Savings Fund, and annuity insurance premiums, they all share a single combined ceiling of 500,000 baht per tax year. If you contribute 500,000 baht to RMF alone, you have exhausted the entire retirement savings deduction for that year. SSF gives you nothing additional on top. The ceiling is shared. This is the misunderstanding that generates the most expensive errors. Let's get into the mechanics. How does RMF actually work? You purchase units in an SEC-regulated fund through a Thai-licensed platform. Major Thai banks offer these, as do dedicated fund platforms. Your contribution is deductible in the tax year the purchase is made. Simple enough. But RMF carries a double lock-up condition that you need to understand before you commit. First, you must hold the units until you reach age 55. Second, you must have made contributions in at least 5 separate calendar years. And here is where it gets interesting. they do not need to be 5 consecutive years. Any 5 calendar years in which you made at least one purchase count. An expat who buys RMF in December 2025 and makes a second purchase in January 2026 has already ticked 2 of those 5 calendar years after just over 30 days of ownership. If you exit early, redeem before meeting both conditions, the Revenue Department claws back every deduction you ever claimed on those units, plus a 1.5% surcharge per year on the amounts claimed. That is not a fine you want. So this is a long-term commitment. But for expats planning to stay in Thailand, or those who want the deduction now and are comfortable holding until 55, the maths are compelling. One more RMF rule worth knowing. You do not need to contribute every single year, but you cannot skip more than 1 consecutive year after the first purchase. Skip 2 years in a row and the early redemption penalty applies automatically, even if you have not sold a single unit. SSF works differently. The lockup is simpler. 10 years from the date of purchase. No age requirement, no minimum number of contribution years. Buy units before December 31st, hold for 10 years, and the deduction stands. The trade-off versus RMF is the longer holding period. A decade versus reaching 55. But for younger expats who are nowhere near 55, SSF can be the cleaner structure. The same combined ceiling applies. If you have already used the full 500,000 baht through RMF, SSF adds nothing that year. If you have used less, SSF can fill the remaining gap up to its own 200,000 baht individual cap. Now, the single most important thing in this entire video, and the reason more expats miss this deduction than any other. The deadline to invest is December 31st, not March, not April. December 31st of the tax year itself. The Thai tax filing deadline for the 2025 return is approximately March 31st, 2026 for paper filing, and around April 8th, 2026 for online submission. Those are the dates everyone focuses on. Those are the wrong dates. You cannot buy RMF units on January 15th, 2026 and claim them on your 2025 return. The investment must exist by midnight on December 31st, 2025 for the deduction to apply to the 2025 tax year. The investment deadline and the filing deadline are separated by up to 98 days, and confusing the two is the single most expensive mistake expats make with these funds. Because once January 1st passes, that deduction window is gone permanently. You cannot reopen it. You cannot file an amendment. The year is closed. If you are watching this in Q4 and you are a Thai tax resident with meaningful assessable income, the question you should be asking right now is not, should I do this? The question is, how much assessable income do I have this year? And what is 30% of it? Let's be precise about who this applies to. You qualify if you are a Thai tax resident, meaning you spent 180 days or more in Thailand in the calendar year, and you have assessable income. Post-POR 161, that assessable income includes money remitted from abroad in the same year it was earned. A retiree remitting pension income, a digital nomad remitting freelance earnings, a consultant remitting salary, all of these now carry Thai PIT exposure for residents. And all of them can use RMF and SSF to reduce that exposure. There is no minimum income threshold to use these funds, but the deduction is percentage-based, 30% of assessable income, so the absolute saving scales with what you earn. Someone with 500,000 baht in assessable income can deduct a maximum of 150,000 baht through RMF and SSF combined. Someone with 2 million baht in assessable income can claim the full 500,000 baht ceiling. Smart expats who understand this are not waiting until December to think about it. They are calculating their expected assessable income in October, determining the optimal contribution size, and placing the trade with enough lead time to ensure the units settle before the year-end cutoff. Fund settlement in Thailand typically takes 2 to 3 business days. If you wait until December 31st itself, you are gambling with your deduction. One thing to take from this video: the deadline is December 31st, not March, not April, not whenever I file. The investment must be made before that date. If you are a Thai tax resident with remittance-based income and you have not looked at RMF yet, the time to calculate your position is now, not in February, not after you receive a tax bill. The Thai government built this mechanism to encourage long-term savings, and it genuinely works in the taxpayer's favour. Up to 175,000 baht returned to your pocket annually from a fully regulated, fully legal structure. That is the deal on the table. If you want the full breakdown of how to calculate your optimal RMF and SSF contribution, which Thai SEC licensed platforms expats are using, and the exact line items on the Thai tax return where these deductions appear, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com or subscribe to this channel so you do not miss what's next.